Hello, everyone. Welcome to this lesson on fixed asset register. And in this lesson, we are asked to complete the fixed asset register on equipment which was sold on 31st of October 2023. Right. And we are given the pre-adjustment trial balance on 31st March 2024, which is this is all the information from the pre-adjustment trial balance, and we have this additional information which is given to us, right? Now we need to select the relevant information that is required in order to answer this question. So the relevant information that we need for answering this question specifically is we need to look at from the additional information. Because of you were asked to complete a fixed asset register on equipment that was on the 31st of October, what we need to look at is this information here. And then from this information, we have the date in which the equipment was bought, which was on 1st January 2020. And we have the cost price. And we were told that this equipment was sold on 31 October 2023, right? And then from there, this is the bulletin that we need to answer this question. And another bulletin that we need is this one, this information here, which tells us the percentage rate of depreciation, right? And now when we complete this fixed asset register, we are going to have an asset. What is the asset that we are keeping track of? It is an equipment, and we were told that it was bought on 1st January 2020. So the date of purchase is 1st January 2020. And the cost price is 120,000, which is given to us. We just fill it in there. And the depreciation rate, it's given to us also. The depreciation rate on this equipment is 20% per annum on cost price, right? So that's the rate. The rate is 20% and the method is on cost price. Now, this is different from the diminishing balance method. There's a difference between the cost price method and a diminishing balance method. But in this lesson, we'll be focusing on the cost price method, right? So now we need to fill in this information here. Now, one thing that we need to note is that the 31st of March marks the end of the financial year. Now we need to calculate how much did this equipment depreciate by from the time it was bought up until the 31st March of 2020, because this equipment was bought on 1st January 2020. So we need to look at the depreciation from the time it was bought up until that financial year, from 1st March 2020 up until 31 March 2020, right? So we are going to keep track of that. So what we are going to do is to use the rate. Our rate is 20%. We say 20 divided by 100. And remember, the method is on cost price. So we are always going to use the cost price, which is 120,000. There is our cost price. And now we need to count the number of months that this, the number of months that this equipment is depreciated. So when we count from January, first it's January, February, March, that's 3 months. And we get this, we say 3/12, right? And therefore that will give us, when we plug all of this into the calculator, it will give us 6,000. And then the accumulated depreciation at this time is 6,000. We just take that 6,000 as it is because there were no previous accumulated depreciations are depreciation of an equipment in previous financial year. So this is the first financial year for this equipment. So the only accumulated depreciation will be 6,000, which is this amount, right? And therefore, the book value of this machine, of this equipment, the book value is the value of that equipment after it has depreciated. So its value was 120, and then it depreciated by 6,000. That means now its new value, which is known as the book value, we are going to say the beginning, which is the cost price, which is 120,000 minus the accumulated depreciation of 6,000. And it gives us that at the end of this financial year, its value was 114,000, right? And then now this was the first financial year. Now we look at the second financial year that this equipment was bought. And the second financial year ended on 31 March 2021, from 2020 to 2021, right? So that will be the end of the second financial year for this equipment. And then to calculate the depreciation for that year, we are still, remember, the method is on cost price. So we are going to take the cost price to which is 120,000, which is this. The rate did not change. We are still on 20%. And now, since we have the full 12 months, we are going to have 12 over 12. And that will give us a depreciation of 24,000. And now the accumulated depreciation of this equipment from the time that it was bought, we are just going to take this accumulated depreciation of 6,000, and then we add to this new new depreciation of this financial year, which is we are going to take the 6,000, we're going to add 24,000, and that will give us 30,000. And to calculate the book value is the cost price, which is 120,000, minus the depreciation, the accumulated depreciation for that year. Don't take the depreciation, take the accumulated depreciation for that year. So we say the cost price minus the accumulated depreciation for that year, and that will give us that its new book value, it's 90,000. That means that if we were supposed to sell this equipment at this time, we should sell it for 90,000. That's what its value is, right? Now we go on to the next financial year, which will end on 31st March 2022. We do the same method as we've done here. We take the cost price, which is 120. The depreciation rate is 20%. And we have the full year, which is 12 months, right? And we have this is still the same as this because we have the full year and the rate did not change. So this will give us 24,000. And now the new accumulated depreciation for this financial year, we are going to say this amount plus that amount. So each accumulated depreciation will be the accumulated depreciation from the previous year plus the depreciation of this year. It gives you this. And then we take this accumulated depreciation plus the depreciation of this year, and then it will give us the amount here, which is we take this 30,000, we add this 24,000, and that will give us 54,000. And now the book value will add the book value of this equipment on the end of this financial year will be, we take the 120,000, we subtract the new accumulated depreciation, which is 54,000. And that's what we write here. And then from there, we just plug all of this into the calculator. We get that the book value of this equipment is 66,000, right? Now we go on to the next financial year, which will end on 31 March 2023, right? So on 31 March 2023, we still have the full year, the same as these full years. So this does not change. We still write it as it is, and the rate did not change. This will remain the same, and that will give us 24,000. And to get the accumulated depreciation, we say this accumulated depreciation from the previous year plus the depreciation for this year, and that will be 54,000 plus 24,000. That will give us 78,000. And the new book value will be the cost price minus the accumulated depreciation for that year, which is we have 120 minus 78,000. That will give us 42,000, right? Now, When was this machine sold? It was sold on this equipment. It was sold on 31st October 2023, right? So we need to count the number of months from this month to the time that it was sold, right? So now we won't get to the 31st of March 2024 because it was sold on 31 October 2023, right? So in other words, for the time that this equipment was sold, it wasn't a full year. We need to know how much a depreciation was, depreciation was there from this financial year up until the time that it was sold in the next financial year, right? Which is, we are still going to use the cost price, which is 120, because the method is on the cost price. The rate did not change, but now the number of months change because we are going to count from 31st of March. Now, we are going to say the 30th of April. We are going to count from April. So we have April, May, June, July, August, September, October. That's 7 months. That's why we have the 7 here. And we divide by 12. And now it will give us that the depreciation before the machine, the equipment was sold, it's 14,000. And the new accumulated depreciation is going to be 78,000 plus the 14,000, which will give us that it's 92,000. So that means that the total accumulated depreciation of this equipment when it was sold, it was 92,000. And therefore, the book value for this equipment will be 120 minus the accumulated depreciation before it was sold, which is 92,000. And this will be 28,000. Right? So with this book value, the book value will help us to know if we sold the machine at a loss or we sold the machine at a profit. If we sell it at this value, there's no loss, there's no profit. But if we sell it at a value which is above this, we have a profit. And if we sell it at a value which is below this, it's a loss, right? So that's how we do the fixed asset register on equipment. And this is how we do these calculations.